Welcome back to another segment of Pump the Brakes. My name is Andre. I'm with Harari Wealth Management, and here now the news. Man, I like hearing that. Here now the news. I'm stealing that from Roger Grimsby. If you're old enough, you'll know. If not, go way back to when the news, what was that? ABC 7, and that's the local news here in New York City. That's how we used to open the show. And there wasn't weather every 4 minutes. So let's get to the news. Really want to talk about in this segment what's moving the marketplace, what's making some people have anxiety, people have less anxiety, what you're seeing on your statements, and of course, what you may be hearing in the news, as I mentioned previously. Today is June the 10th. So all of the data that I'm looking at will be, let's say, for instance, the market indices where they closed yesterday would be as of June the 9th. So I always like to say that ESP stands for not being clairvoyant, but for economic, social, and political events. And that is what moves the marketplace. Anything else is a question mark. And I like to say that creates uncertainty, but sometimes political information definitely can move the marketplace just as well as economic and social events. So we have all of that going on now. I don't have to go into depth. If you've been under a rock, get from under a rock, and you'll know most of what's been going on, good, bad, and ugly. If we take a look at the market indices, these are all the benchmarks, major markets that we take a look at. That when I say, hey, the market's up this way, it's up that way, generally I'm speaking of either the Dow Jones, the S&P 500, the NASDAQ, the Russell 2000, Morgan Stanley EFA, which is looking at the overseas market. So let's take a look at where they closed as of yesterday, what the year-to-date numbers are. So the Dow Jones is pretty much flat. It's up 0.5% so far for the year. The S&P 500 is up 2%. The NASDAQ is up 1.45. The Russell 2000 is down. That's your small cap stocks. That's down 3.8%. The S&P 400 mid cap, that's down 2%. And then we have what I call the bucking trend of them all, which would be the Morgan Stanley EFA, which basically gives you an idea of what's taking place in Europe, Australia, Far East, and other Eastern Asia marketplaces. That's up 16%. If we take a look, because I know, getting some calls relating back to maybe the last video that I did, most people were looking at their statements, listening to the news. If we go back either late March, early April, we had market sell-offs, whether it be in stocks or bonds for that fact. And we just take a look at where the Dow Jones is. It is up 12% from the market lows. So although it's flat, it was down a lot more. The S&P 500 up 2%, but it was down a lot more. It's up 18% from the lows of the market at that time in April, say around April 8th. And if we look at the tech-heavy NASDAQ, that's up 22% from the lows in the marketplace. All of that did happen during April. And I'd like to say, are we on firm footing? The markets are still fragile. If we look at what, let's say, traders, more so. Not that there aren't individual investors that are fragile, because I like to say individual investors are always fragile. But with that being said, most of the money that we see moving are traders and institutions. So right now it's fragile because of the next economic and political items that I'm going to discuss. So it is still fragile, could move. Don't expect major sways in the market, but it's always possible in the days that we are currently residing in. I should talk about the bond market just as well, because that, although it's the bigger market of the two, stock versus bonds, it does a lot more, has a lot more intrinsic value to our lives. The 10-year treasury right now is about just under 4.5%. It's at 4.48, and that's off the lows of 399 and off the highs of 4.8. April lows around April 4th, the highs around January 15th. If we take a look at the 30-year Treasury, that's at just under 5% at 4.95. If we look at the lows on the 30-year, it was at 4.38, and the highs at 5.09% on May 21st. We reached those highs at that point in time, and that had a lot to do with the downgrade of the U.S. Credit debt. So that happened around May 16th. And I'll elaborate a little bit more on that in a moment. Something that's also very important is always oil and where oil is trading, because oil, whether it be a byproduct of many of the goods and services that we use, it is also very important when it comes to inflation. So right now, if I look at Western crude, which is the U.S. versus Brent crude, which is European oil, usually the difference is about maybe $2-3. But Western crude, the July contract this morning, being June the 10th, was $65.39 off the highs of this year in January of around $83. Now, that doesn't mean because the U.S. is pumping tons of oil. It's because when you have volatility in the market and threats of inflation, it means slower growth. And if you have slower growth, that means less use of petroleum. So that is the speculative trade that has taken place, and that has also brought down the price of oil. And OPEC, which is a major distributor, it's a cartel of different companies, not a negative thing when I say cartel, but a cartel of various countries that produce oil, and they're looking to increase the supply, which means more supply, lower pricing. So that is what we're dealing with at this point in time. Let's go on to political events. I think most people are aware of tariffs. I'm going to talk about that now. One of the things that's taking place in London is the meeting between the U.S. and China, and they're trying to come to some agreement on tariffs, but more so, not as much as tariffs. I think, if I look at my opinion, tariffs are going to be here to stay in some way, shape, or fashion. But what negotiations are taking place right now are really to try and figure out, what more can we get from both sides, between the two powerhouse countries, China and the United States. So one of the big things is rare mineral earth and rare earth minerals. I'm chopping that up, which, you can see in appliances, autos, medical imaging, defense systems, batteries, glass. It really affects a lot of goods that are being used inside the marketplace. And China does have a lock on that. They build up a war chest of those rare earth minerals from various countries around the world, while the U.S. wasn't paying attention or just didn't really care. With that being said, they have about, say, 70% of the rare earth minerals, and the United States is trying to negotiate how they can get their hands on more leases from them to utilize in production domestically. If we then also take a look, what else is going on during this period is corporate earnings. Corporate earnings have, by and large, been pretty good. If we look at your average earnings for growth companies in the first quarter of first quarter here in 2025, we've seen that earnings have grown on average of about, say, 12.8%. And that's exceeding expectations. If we look then at some of your high-flying tech companies, some people call them right now the term is the Magnificent Seven. That's comprised of Apple, Amazon, Google, also known as Alphabet, Meta, which is also known as Facebook, Microsoft, Nvidia, and Tesla. Their earnings have grown. They've seen growth of roughly about 25%. But then again, as I said, those are high flyers versus, let's say, the norms. So let's, moving on from there, going back to tariffs. Now, most people are aware of the Freedom Day, which is roughly when the current administration came out around April 2nd and started talking about, or Freedom Day, Liberation Day, where they were talking basically about how we're going to try and get tariffs raised on various countries as a tool to negotiate to get better deals for imports and exports. With that being said, that was one of the reasons that you saw the sell-offs inside the marketplace. And it created and has created a lot of uncertainty. There are a lot of areas that I can touch on. I'm going to try and do that to keep myself within my time frame. But if you look at it, it creates higher prices for imports. And basically that means that consumers pay higher prices. And as I said earlier, my thought is that tariffs will be here to stay in some shape or fashion, maybe not as high. Right now, there's a moratorium until July 9th because if you paid attention, as I said, you weren't under a rock on April 2nd. If you looked at what the proposed tariffs would be, there's a moratorium on a lot of them until July 9th. July 9th, I believe, is that deadline date where the U.S. administration, the government, will then hopefully have deals with various countries to have lower tariffs. If not, they will raise those tariffs significantly, which, again, as I said, will raise prices. With that being said, the uncertainty that you see there is in the marketplace because that creates higher prices. Companies, can't really get a gauge for what their financial forecast, what they will be doing in the future. That limits, or may limit the way that they decide to spend their money in the future. A term for that is CapEx. That's future spending, whether it be for hiring, for purchasing of other companies, or to expand their businesses. There's a lot of capitulation there at this time. And of course, if there's capitulation and uncertainty, that can also look at austerity cuts, otherwise known as layoffs. That has, right now, if you look at tariffs and the way that some individuals have felt, we can use Canada, you can see major hits to tourism domestically because of that. New York City is definitely taking a hit, and other cities have, because some people have just said, hey, especially allies, we don't want to go to the U.S. So it's taking away what's considered that U.S. exceptionalism, and they're going elsewhere. They're taking their money elsewhere. Just today, if I look at Freeport-McMoRan, in their copper division, their CEO had talked about how they've had a boon because of tariffs, but she does believe that there's a warning that the tariffs could hurt the industry, going forward, whereas, it will not help them as much. Tariffs uncertainty has also created volatility in the U.S. dollar. Why do I say that? If the dollar is up high and if you're traveling abroad, you love it. But if you own a business, whether it be small, medium, larger, or large business, it hurts exporting products abroad because it makes those products have higher prices, and it hurts competition with other countries and other companies. So that's not a good thing. If we look at other things with tariffs here, where you're seeing volatility is because there's tariffs on chips, there's tariffs on what I call sectorial tariffs, which means certain sectors of the business. There's proposed tariffs on pharmaceuticals. So that's hurt pharmaceutical stocks, And, if we go back to Liberation Day, basically this administration wants companies to bring a lot more of their business back home. So they're trying to utilize tariffs to exploit, but it's also hurting the marketplace at times. Yes, from a standpoint, if you look at your statement from March, April, and you get your statement in the next few days, you'll see that you've recovered, quite a bit. Maybe not exactly 100%, but maybe close to that. But as I said, the marketplace is still fragile because there is still uncertainty out there with a moratorium until July 9th of when a big decision day. On Wall Street, many people, and if you don't have to only be on Wall Street, but the term taco was created because of the capitulation that you're seeing from the U.S., more so the president, on tariffs. And, they use the term taco because that means Trump always chickens out and capitulates. I know he doesn't like that, but that's what you're actually seeing at times. Let's see. Let's move on to legislation, which is also something that is affecting the overall marketplace just as well. You have what's called the Great Alliteration Bill, big beautiful bill. Some people have other words for it, which has passed the Senate and illustrates a lot of budget cuts, basically to create a lot of tax cuts and spending in areas that, maybe that's where some cuts should be taking place. But where it's most noticeable is where it will be hurting a lot of poor and working class people. Why do I mention this? It sounds like maybe a political stance. No, because it also partakes into what we talk about when it comes to investing. But if we take a look at where you're seeing social cuts, you'll see it in Medicare, Medicaid. You'll see it in SNAP, also known as the supplemental, I can't get words out my mouth today, Supplemental Nutrition Assistant Program, which does hurt not just the poor individuals that utilize that social program, but it also hurts farmers and businesses that utilize it and provide products and services to poor and working class people that are on that program. So, it hurts farmers because they provide veggies, dairy products, meat, poultry, and grains. It also can hurt individuals because it also cuts back on this bill on utility assistance. When we talk about a time where prices of energy is going up, I know definitely here in the mid-Atlantic states, a lot of people will see the price of their energy bills going up just as a time that it's getting warmer. So these are things that take into place. Also, if we look at the Affordable Care Act, cuts there, student loans, also looking to weaken environmental regulations. But most importantly, if we use as an example, healthcare cuts. If you have healthcare cuts, you'll have more sickly people, and you'll also have more people that are dependent. Either A, you'll have more people that are sick, not getting care, which is always terrible, but you'll also have more of a dependency on systems where people can't pay. Well, if people can't pay, that creates a scenario where premiums are going to cost a lot more for individuals that do pay. It can also cause hospitals to close, nursing homes to close, so on and so forth. So with that being said, it may add about anywhere from 2.5 to nearly $5 trillion to the deficit, which, as I mentioned earlier, that is the reason why you see the cut in the credit rating for the United States. I got to speed up, so I'm not going to be able to touch on a lot of things, but what we do have next would be some economic news reporting. We had the jobs report that came out from the Bureau of Labor Statistics last week. 139,000 jobs were added versus a forecast of 125. The unemployment rate remains at 4.2. The job market has cooled but hasn't crumbled, hence interest rates are remaining where they are. GDP first quarter, that's the gross domestic product. That's basically talking about all products and services that are being created in the United States. We saw a negative in the first quarter. That means that the economy contracted by about 0.3%. Two contractions do mean a recession. That's your technical recession. So what do we have going forward? We have the CPI report. That's your inflation report. That comes out tomorrow, which is Wednesday. Estimate is for it to be an increase of 0.2%. And on Friday, we have the consumer sentiment report that's issued by the University of Michigan. Most importantly, I'd like to tell you is to stay invested. That is the key thing. Stay invested. If you have bonds inside your portfolio and you're a retiree, or even if I say stay invested because you have long-term goals, that's the most important thing. If you have bonds or you have dividend stocks or you have mutual funds with bonds and you're taking income or you're not taking income at this time, take the income because interest rates are high and some of the dividends are high. So take the income. That's the offset at this point in time. But most importantly, stay invested. Federal Reserve, next meeting, I believe, is not until next month, but they're staying steady. Interest rates will not be coming down. Final word. Personal note is what I call the deficit reduction is very important. Why is that important? Because this bill that I mentioned, the alliteration bill, will only increase the deficit, which may not hurt you at this point in time, but it will hurt your kids and your younger loved ones going forward. It's just like saying, hey, I don't care about climate change. I'm not going to be around that long, but it will affect other people, your loved ones in the future. So with that being said, that was the news. Please like, share, and subscribe. Until the next time that we speak, if you have any comments, questions, leave it right there in the commentary. And it's always good to have you folks on. Until we speak again, peace be with you. Take care.